We're going live.
Awesome.
Hello, everyone. Welcome to the Unlocked Tuesday live stream. We are here every single week with all sorts of different topics, tips, tricks. If it is related to real estate, we are here to support you and to provide training. So today we have our personal financial planner, Eddie, I practice Knezevich, who is a long-time Columbus, Ohio financial planner. He has grown his business from the ground up, and we're going to hear all about that today. Our main topics that we're going to cover, we are talking about whole life insurance. We're talking about a couple other little unconventional ways that you may not know on how you're going to pay for real estate, and a little bit about other people's money, even though we did touch on that last week. So if you want to know more about private lenders, other people's money, we have a training from last week that goes in depth. But today we'll touch on that just a bit because Eddie is an expert in that field. So let me turn it over to you for a quick intro.
Jesse, thank you so very much for having me today. I appreciate the warm introduction. Guys, I'm Eddie Knezevich. I'm the owner of KMFG. We also own West Point Financial Group and Knezevich Properties. And been here in Columbus, Ohio for 35, almost 36 years of my life.
You're only 32. How's that possible?
And so a little bit about our business, shameless plug before I dive in and kind of give you guys my story. I own and operate an independent, privately held wealth management firm here in the Columbus region. And our main focus is people in and around the real estate investment community. So I've spent 13 years in the business, and of the last 13 years, all of it has been working with people in and around the real estate community. I myself am also a real estate investor, and what we do is teach people how to get their money out of the market and into real estate, or in the market and into real estate, but a little bit different than your big box places that you guys are familiar with working with. So today's conversation, what I'm going to be talking to all of you about, I'm going to start with a slide presentation.
He's prepared.
I think it's not allowing me to click on it for whatever reason.
I do it. There you go.
There we go. So guys, the first thing that I'm going to go through, I'm going to keep this very high level. I know that I've only got 28 minutes, so I'm going to keep this really high level, but I always kind of start out with my personal journey. So how did I get here today, and why am I qualified to teach you guys on this topic? I grew up here in Columbus, Ohio, right outside of New Albany in a small town called Pataskala. And this is actually my childhood home. So very humble beginnings. I grew up in a single parent LGBTQ household. Just me, my mom, my sister, and our home was, it looks really pretty now, but it was, 950 square feet, little tiny shoebox, 2 bedrooms, 1 bath, humble beginnings. And graduated from Ohio State, first one in my family to go to college. Graduated in 2011. It took me 5 years to get my 4-year degree. So
victory lap.
Took the victory lap. And I got into wealth management after my first corporate job. So I got into corporate America, and Jesse and I, we relate on this, but I got into corporate America, and I could not stand working for somebody else, and I couldn't stand performance reviews. So I was always the first one in the office, always the last one to leave, always took on more than my team members. And when we had our first performance review, realized that I needed a job where the pay was based on the merit that I had put in. And so I quickly realized that wasn't going to be the right career path for me. So I stumbled into financial services, spent the last 13 years doing that. When I started out, though, it wasn't all roses and butterflies. So 2013, 2014 was my first couple of years in the business.
Hard years.
Hard years. So I always ask my agent clients and my real estate investor clients, like, who's been dead broke? Who's been flat busted? I was dead broke. I was flat busted. 2013 and 14, I literally was, it used to be a Check Smart. It's now where I think it's Urban Meyer's Chop House is on High Street. But there used to be a Check Smart there, and I was literally pledging my next paycheck every single week or every 2 weeks because I couldn't pay rent. I was living on Bryden Road and Ohio Avenue it was a really bad neighborhood at the time. Now it's a really nice area, but at 2013,
we have some rentals over there. You shut your mouth.
yeah, in 13 and 14, it was not nice. And I drove a broke down Nissan Sentra. So I've been dirt poor, flat broke, dead busted. Didn't know what I was doing, but I was determined to win. Here's literally my basement apartment that was over there. I had one stovetop burner that worked. I didn't even have a garbage disposal, didn't even have a dishwasher.
Wow.
And I had one window in my entire apartment. So it was depressing. It was a tough time. I moved out on my own. I actually got an office down on Long and High, and I opened up my first office on Long and High in 2014. And I went out on my own independent, and I started building my team. I started hiring people and started realizing like I can do this. You know, I'm not the smartest guy in the room, but I'm definitely not the dumbest. And if I surround myself with enough smart people and I take care of the people that are around me client wise, like business will continue to grow and you know, it'll be good. So I carved out my niche in the real estate investment space.
Yep.
2014, 2015, I started house hacking. So Jesse, I know you also love this. I bought my first property in 2014 in Schumacher Place. And at the time, it was kind of when Schumacher Place was starting to boom. It was before the Southern Orchards boom had happened. And I paid like $170,000 for my first property. And I bought it and I spent the next like 6 months, moved into it, was living in a construction site, redid it room by room by room with any additional dollar that I made in my business. And I fixed it up. Place was absolutely drop dead gorgeous when I was done with it. And I lived in it for a little bit, just shy of 2 years, right after 2 years, I think 2 years and like a month. And I ended up selling it for $375,000. So $200,000 profit less my real estate fees or real estate agent fees. And then I took that money and I snowballed it into my next property, which ended up being a duplex. I got addicted to multifamily real estate after that. So we went from 0 to 100 real quick. So my wife and I, we've acquired 47 units over the last handful of years. We're not where Jesse is yet. We're working our way up there. But our goal is to get to 100 units and be able to have, you know, a sizable amount of passive income. So we went from 0 to 100 real quick. Joke. We do a lot of things from like high level cosmetics all the way to full on guts. So here's kind of some of the facelift stuff that we've done. We've done everything from full rehabs where, you know, we're gutting places. If you look down here at the bottom right, this is actually a before. We removed a wall, removed a kitchen. Here's what it looks like over here on the left. And then in the center, that's actually the finished product. So all of our products, we try to make them ultra high end and try and maximize what we're getting for rents in the markets that we're in. We are not a slumlord. We don't believe in throwing lipstick on a pig. We are, hey, go in, gut it, make it beautiful, make it something that somebody wants to come and stay in for a very long time and then they don't leave. All the properties that I personally do are all long-term rentals. I've never gotten into the short-term rental game yet, but you know, open to it and could potentially see it in the future.
Yeah.
Team continues to grow. So we now have 12 full-time associates that work for us. And our business primarily focuses in 3 segments of the market. We've got traditional wealth, real estate, and then alternative assets. And we kind of encompass a little bit of all of those different areas of the market. And so team continues to grow. We've gotten bigger. I've also gotten married, had some kids. These pictures are outdated. I actually have 3 children now. So I've got
third child always getting left off.
Yeah, third child's gotten left off. I need to update my presentation, but I got married a couple years back, and then we have had 3 kids in the last 4 years. So me and my wife have been busy with family expansion and continuing to kind of grow our businesses. And fortunately for us, we don't live in a basement apartment on Bryden Road and Ohio Avenue anymore. So last year, or 2 years ago now, 2 years ago this March, we were able to acquire our forever home. We now live in New Albany, and we actually we're building a basement apartment right now. So
Nice.
we'll have our own basement apartment. But yeah, so, the reason why I'm showing you guys this is literally 2014, 2015. It was less than a decade ago. Dead broke, flat busted basement apartment. And, the whole reason why I'm showing you guys this is because you can literally, this is the one country in the world where you can go from dead broke, flat busted, no nickels to rub together, to living in a really nice home, drive the car that you want, create the pathway for your own future. And I'm going to show you guys kind of what I've done for myself and some of the things that we help people out in doing that you guys could be doing for yourself that you're probably not getting taught, that are little tips and tricks that are out there in the market that you guys could be doing with your own capital that can really accelerate and get you from 0 to 100, really quick. So I'm going to kind of walk through some of that stuff with you guys. These are just some of the interior reno pics on the house as we finished it. And so I'm going to kind of skip past this, and I'm going to go right into really the biggest thing here is how do you actually do this? So
that's why we're here. People want to know that your story, so inspiring. I love it, but I want to make sure that our audience gets some tangible takeaways on how they can have the same rise to success that you've seen.
Yeah. So this is it. So really, all the other stuff is high level. What are the things that you should be doing as like an agent or as a real estate investor to kind of set up your self for success? But there's really four main methods that I've tapped into myself that have really, really, really helped me scale my rental portfolio. Me and Jesse talk about this all the time because Jesse's doing it for herself right now also, and she's been doing it longer than I have. And so we're going to talk about these different methods, and I'm going to teach you guys some tips and tricks that you're not going to hear out from your financial advisor. You're not going to hear from other financial professionals because they're not talking about this stuff because it doesn't benefit them. They're not going to tell you the things that benefits you only. And what I want to do is I want to teach you guys what benefits you. And if I can teach you something that benefits you, maybe I can help you out with some of the things that also simultaneously benefit me later on down the road. And that's kind of the value add proposition that we give to our clients. So
I want to make sure that we definitely cover cash value life insurance because you introduced me to this concept, and it's, if you've heard of infinite banking or becoming your own bank, that's what this is referring to. And it blew my mind. And had someone told me about this option even 5 years ago, I'd be in a different financial position today. So I definitely want to touch on
the one that we're going to start with. We're going to start with cash value life insurance. We're going to go from most conservative to most aggressive. And we're going to talk about all these. So this is the traditional way. So most investors, and this is how I was trapped when I first got into investing in real estate. I did the exact same thing that all of you guys on this call are doing. You guys are saving up your money. You're working a job every single day. You're saving up 15 to 25% of your money. You're putting a down payment on a property. You're securing that property.
You guys make a comment. Let us know if you have bought a rental property the traditional way, 20% down.
Yep,
let us know if you've done that.
Down.
Yeah.
Now, the problem with this is it doesn't allow for you to acquire many of these things at once. It single-handedly restricts you. What it also does is it puts strain on future opportunities. So when you decide that you want to go get the next one, you've got to start the whole process back over. Okay. And it's crazy. And so the time frame to scale is very difficult. If you were at the rate of saving up for one property at a time, Jesse and I would maybe be able to have 10 properties in our lifetime, maybe 10. But utilizing lines of credit, leverage, and leveraging assets that you own against yourself, you're able to scale infinitely without restriction. So how does cash value life insurance play into this stuff? So this is a very conservative way, if you aren't a risk taker, that you can start to park some of your capital, grow it, but also use it. Have your single dollar working in two places at the exact same time.
Yep.
So what you do, there's a certain subset of policy types out there. And I always say not all policies are created equally, because there's a lot of people out there that are bad actors in the industry that try and push things out there that aren't advantageous for the client. They're advantageous for the advisor. Now, what you guys can do is you can acquire these mutual participating, limited pay, high early cash value, permanent life insurance policies.
That's a mouthful.
It's a mouthful. They have some unique value propositions that make them different than the other stuff that's available in the market. One of them, depending on the year you acquire it, the carrier that you go with, and your health rating, these companies will give you a guaranteed baseline foundational internal rate of return of anywhere between 2 and 4% per year throughout the life of the contract.
And it's guaranteed.
It's guaranteed, no risk, not tied to the stock market. Stock market goes to zero. These companies are still printing yield every single year.
Can you think of any other product with a guaranteed return like that? I can't.
Yeah, there's not anything that's liquid. Now, if the carrier happens to be profitable, in addition to the guarantee, these companies will also produce what's called a tax-favored, tax-free dividend, which can either pay out to you, the consumer, in form of a cash payment, or it can be reinvested back into the cash values of your policy, and it compounds that cash growth. Now, it's very important to note the dividend is not a guaranteed portion of the policy. This is only the reserves and growth of the carrier. So when you buy these policies, you actually become an owner of the company. You are a shareholder. You're a stockholder in the company, because the company doesn't have stockholders. They have policy owners. So all of the profits get paid out to those policy holders in form of a dividend. Now, once you have money inside of these policies, you can borrow, you can pull out all of that cash value. You can get your rental property with that money. You can fix it up, get it rented, cash out, refinance, pay yourself back, rinse and repeat.
Yep.
Now, the unique value proposition here is you can even add a third-party line of credit against the capital that you have inside of your policy. So, for example, these banks, I don't know if you guys knew this, but banks are the largest holders of life insurance in the United States of America. Banks buy a product called BOLI, bank-owned life insurance. Banks buy billions and billions and billions of dollars of bank-owned life insurance. And they utilize this as a yield product. And when you guys have depository accounts, when you guys have a savings account with Chase Bank, where do you think that yield comes from? The yield comes from the bank went and took a block of cash. They bought BOLI, they bought T-notes, they bought T-bills that produce a 4, 5, 6, 7% yield. They collected that as profit. They paid their bankers, and then whatever's left over, they give to you in form of depository growth. So banks utilize this stuff in their own balance sheet, so they understand the value of it. They will actually give you a line of credit up to 95 to 100% of whatever your cash value is, at generally lower interest rates than what the insurance carrier will. So like right now, policies can grow anywhere between 8 and 12% on a guaranteed tax-free basis. And if you subtract out your points to borrow against your money, your points are somewhere between 3.5% and 5.5% in today's dollar.
Nothing.
So literally nothing. And you can use that line of credit to then go reposition your capital and put it into a piece of real estate. Once it's in the real estate, you hold it for 6 months, 1 day. Then you go to your traditional lender and you do what's called a cash out refinance.
You guys, if you've been following on this page or you've been in Burr for Beginners or anything, you are familiar with a cash out refi. It is one of the core components of what we do in the Burr method.
Yep. So you pull out all of your money, you put it back into your line of credit, and then you recycle the line of credit. Now, I just bought 2 properties in 1 year, but I only saved my money 1 time. Next year, because I continue to save inside of that vehicle, the insurance carrier and the line of credit company will actually allow for you to increase your line of credit without going back through underwriting up to your new statement of cash value just based on what you've saved. So the more money you save in that vehicle, the more property you're able to acquire. So guys like me, gals like Jesse, we're able to go out and buy 3, 4, 5, 6 of these things at one time, but we've only saved our dollar once, and our money's now growing in the life insurance while we're borrowing against it at a lower rate, and we're using it in real estate. So now we have one single purpose dollar that's growing in two places at the exact same time.
It's mind blowing. This is a single example of how the rich get richer. To recycle your own money to gain more assets. Let me back up for a second, because that was a lot of really good information. I want to put it in like a practical sense. Yep. So say there's a minimum, right? There's a minimum before you can borrow from yourself. What would you say you need to have into your life insurance policy?
I would say it's really about how much you're going to be using to acquire the property. So think about it this way: like if your property down payments are 20,000, you got to save up 20 grand. So, and what people's argument a lot of times is, well, it's going to take me a couple of years. Well, it's going to take you a couple of years to save up in your checking and savings account. So why wouldn't you want to accelerate it, do it one time and never have to do it again?
Okay. If someone had, let's say someone had $50,000, how much invested that they put into their insurance policy, how much would the cash value, how much could they borrow against that?
If they put in
more 50, or less equal?
It's more or less equal to what they're contributing in, depending on how it's structured. If it's structured properly, it's after the first year, it's going to be more or less equal to what they contributed, plus whatever the growth is. So they continue to grow it. It's going to grow. Let's say that the growth rate is, I'm just using easy math, 5%, 10%. If it's 5%, then, and they put in 50,000, they've got $2,500 in growth. So it's worth 52.5 after the first year.
Okay.
Which again is better than your Chase account or your Bank of America account. But then the second year is when it starts to compound. Third year, it compounds greater. As time goes on, it starts to snowball into something much larger. So we've gotten to the point over the last 5 or 6 years where we aren't a prisoner to the bank anymore. Somebody just asked, I missed what the interest rate would be on the borrowed money. Great question. Interest rate in today's dollar environment is between 3.5% and 5.5%. So to put things into perspective, I have a home equity line of credit against my primary residence. My home equity line of credit right now is 9.5%. So if I'm borrowing money, do you think I'm borrowing it for my HELOC or I'm borrowing it for my cash value life insurance policy?
Life insurance, baby.
Borrowing it from the life insurance because it's 3.5%. So I'm saving, 6 points and my money's still growing. Quick, inside that account, what is the growth based off of? Great question. The other question is, what is it based off of? It's based off the growth of the carrier. It's not invested in mutual funds. It's actually invested in their general account.
Okay.
So in other words, these companies, they go out and they buy bonds, they buy real estate, they buy they loan out money, they buy T-notes, T-bills, securities, and their general portfolio, and then also they're selling insurance. So every single year, what a lot of people don't realize is insurance carriers sell 85 to 90% of the insurance company's sales are term or temporary life insurance. This is what Dave Ramsey pitches. Go buy term life insurance. Believe it or not, less than 1% industry-wide of term policies ever pay out a death benefit. So the entire industry, the entire system is telling you to buy something that is never going to pay out. So think about that from a profitability perspective. Why do you think the insurance carriers are pressing that? They're pressing it because it makes them money.
Yep.
So they want you to buy term insurance because they know you're not going to use it, and they know that's all profit for them. So that, coupled with their investment portfolio, is how insurance carriers make money. Then all that profit is then driven, and then they determine a dividend amount, and that dividend is then returned to you in form of growth capital inside of your actual policy.
I think I could have a whole live stream on why Dave Ramsey is wrong.
Yeah, he's great for somebody that's making $40,000 a year that wants to work in corporate America for 30 years and collect Social Security and maybe have a little 401k. But for somebody who wants to be rich, he doesn't build his plans to set you up for success. Could you understand the base years that one would have to deposit before you could borrow against the account? Great question. was 3 years before I could readily borrow against it. Last time you looked at it, great thing. So you're probably looking at what's called retail products. There is a subset of institutional products that most advisors don't push out in the open market that aren't readily available to the public. You have to work with an independent broker like myself, my team, that does this kind of stuff. So I've got a whole team of people in all these other offices around me. This is all they do all day, every single day. They go out and shop with all of these companies and carriers. And no, that's not the case. It depends on how much you're putting in, what your health rating is. But I've got people that are putting in big blocks of capital that are using it in the first year. I've got people that are in year 2. Yes, certainly there's some people that are 3 years and beyond that aren't utilizing it until then, but it all depends on your unique situation.
Yeah,
but
if you're putting in $5K a year, it's going to take you a while to get to the point that it's even relevant to borrow the money. Like, What are you going to borrow, like $15,000 from yourself? It's not going to get you very far on a deal.
Correct. It all depends on your situation. Yeah. So if it's the product and it's not the right product, then that might be the case. If it's deposit, that could be the answer. But yeah, that's essentially it. Call it 20K annual. If you needed to get that 20, you should be able to do it within the first year. Should be able to do it within the first year. If you're not getting that advice, then you have the wrong product mix.
Eddie, when we signed up for this, you guys showed us like a chart, and I don't know, was that like based on my personal situation, or is that a chart you could share with everyone?
Yeah, I mean, I could show somebody something. Here, give me a second.
Is it a standard chart?
It's not. It's based on yours, but I can pull up my own and just show them something.
Yeah, don't pull mine
based
up.
on my life. Just like one of the policies that I have that I could show them that would give them kind of a baseline foundation as to kind of how this stuff operates.
Because I mean, there is so much information, and this is all new. And, the first time Eddie explained this to me was the first time I was hearing it. And, it was all this information spinning in my head. And until I saw this chart on paper, it really clicked on like what I get, right? You put in this amount, and what do I actually get? That's what everyone wants to know.
Yeah. So here's just kind of a baseline foundation. Can you guys see this okay?
Can you zoom in at all?
Can you guys see this okay?
Yeah, we can see it. Yeah. There you go.
There we go. All right. So this is kind of a little bit of a baseline foundation.
Give us the dummy version.
This is the dummy version. Yeah, this will just show you kind of a baseline example. So in this example, this is like $100,000 in annual deposit. Okay. So after 10 years, $1 million in this thing. Okay. In the first year, I'm sorry, what'd you say?
I said, sign me up.
Yeah. So $1 million over 10 years. First year, if you need access to capital, 91,000 of your million or of your 100,000 is available. If you die, 4.2 million goes to the family. Okay. After 10 years, not including your dividends, just cash growth, after the 10th year, you're at 1.3 million. So you're almost at 300,000. You're almost up 30% over a decade in accumulatable cash value. So you put in $1 million, you've got almost 1.3 in cash in it. And again, this doesn't factor in dividends being reinvested, which is another like $272,000. So again, this is just a very baseline, basic, foundational kind of understanding of this. But these are the types of things that we're helping people out with. These are very overfunded. They're high early cash value. They're designed for the client. They're not designed for the person. The advisors on these plans are actually getting compensated very similar to an assets under management model, very similar to your traditional investment advisors are.
So Eddie, is that a chart that I could share with our community?
I'll send you out one. Yes.
Yeah. So why don't you guys, if you want to see that so you can actually study it and kind of understand what's going on, drop, I don't know, send me the chart in the comments and we will send it over. Lizzie will help send that over to everyone, and we will include Eddie's contact info as well. So if this is something that, you want to put money in real estate, that's why we're all here, right? Real estate portfolio. The millionaires own real estate. That is the world we live in. So if you want to buy real estate and can wait, a couple years, maybe you have some extra cash and you want to put it here first, this is a huge step forward versus going straight into real estate.
Yeah, I agree.
Yeah.
And so if you're a little bit more aggressive, I'm going to go through one other quick one. I know you guys usually keep these things 30 minutes, but I did want
I
to give
knew
you
it.
guys
He's a
one other.
talker. I knew it.
I promised I would give the other one as well. I'm trying to present the slides, but it's not letting me. Hold on one second.
No, I'm in charge.
There we
Eddie,
go.
everyone wants the chart. You seeing these comments?
I will send over the chart. I got it.
Okay, I'm adding you back. There you are.
Okay. So really the other thing that I utilize personally, and we aren't going to go into the other people's money thing because I know you guys talked about that last week, but if you are more of an aggressive investor, okay, if you're not conservative, I started out very conservative. My risk tolerance has changed significantly as I've accumulated money in things. But what you can do once you get a little bit more aggressive is the more moderate ways you can put money into the market, okay? And you can invest that capital in the market in stocks, bonds, mutual funds, ETFs, crypto, whatever your poison is. And certain brokerage accounts will actually allow for you to borrow up to 50 to 70% of the capital you have invested inside of that. You're able to do the exact same thing you can do with the life insurance in a stock portfolio, just at a smaller scale. You can't borrow 100% of it, but you can borrow 50 to 70% of it. But the risk here is if the stock portfolio falls, you could have what's called a margin call, where the investment firm has to sell out of the stock to cover the note on the actual asset. So, and we've actually had that happen before for people is stock market falls, and, investment wasn't doing that well, and all of a sudden you have to sell out of that position to do it. But exact same concept, you put money into something, it grows by 4, 5, 6, 10% rate of return, borrow against it while it's growing in the market, utilize that capital to then go and acquire things that make you more money. The rich always get richer when they're using leverage the right way.
Yes.
I know Jesse talks about this all the time. Leverage is extremely important. You cannot be afraid to borrow against things that you own to go get you more money. You got to be confident in your ability to do so.
Maybe you should get some mentorship, just make sure your numbers are good.
Yeah. Make
That
sure your
builds your
numbers are good.
confidence. That's for sure.
Yep. I just always throw this up here at the end. If you guys are ever interested in journeys following, check me out on Instagram. That's my email. That is my personal cell phone number. If you guys don't have somebody in your corner or a team that's helping you guys out with these things, feel free to reach out. Jesse, somebody asked a question. Jesse, how do we meet and how do we come together on this?
What? Who
Do
asked
you
that?
want to answer that?
I can't see any of these comments.
You can't even see them?
No, I can, but no one puts their name on here. So I say every time, can you all put your name on? They never allow it. So I don't know who asked this, but can you share with us how you two met? Yeah, how did we meet? We met
actually
through the Lawrence family.
Yeah.
So Brooke and Liz. Yeah. So Eddie is kind of grew up an LGBT family and was connected kind of in that community through 10-year clients of his. Also in the we say in the family, like, and then connected me and Laura, and that was history. Yeah.
Yep. And it's been a great growing relationship since, and it's been just about what, a year and a half?
I think so. Yeah. Not too long. And I'm telling you, I wish that I knew these things sooner. I wish.
Yeah. And again, guys, that's really the crux of this. The biggest thing is we want to teach you guys, and I know Jessie, this is her primary focus. Our thing is the same thing. Teach you unconventional things that are not going to teach you guys in school. You're not going to hear about it from your traditional people that you're working with. These are the things that you need to know, though, because it's the things that the wealthy people that you see in those neighborhoods that you want to live in, this is what they're already doing. They're already doing it, and you should know it. They're just not telling you guys this stuff. So I'm here to tell you, I'm here to spoil and give you guys the truth that nobody wants to share with you guys. But hopefully you guys found this to be beneficial. Hopefully I gave you a nugget of something you weren't used to or hadn't seen before.
I know I've been in real estate 10 years now, and when the first time we connected was the first time I heard of this. So it's around the people are doing it. This is tried and true. It's just they don't really tell the little people, it's kind of a well-kept secret, but not anymore. We're breaking it out.
Yeah, I love whoever just put that. I got a degree in finance as soon as I started working and realized how much they hide from the public. It's so
Yes.
true. It's
Yeah,
it's honestly
Lars
crazy.
says that.
It's literally crazy. I can't tell you how many things I learned even this year, like from a tax perspective. It's like,
Crazy.
gosh, having a good CPA is extremely important as well. Like separate from a financial advisor, separate from an attorney, like the things that the tax code is 27,000 codes. And you're filing most of the time tax on a couple page document. There's so many things you can take advantage of that are just not taught in the public. So, that's what we're here to do is share. Sharing is caring. I love that. But if you guys have any questions at all, go ahead and throw them in the comments. I'm happy to answer them real quick before I go, because I know Jesse's got to get off this live stream at some point.
I do. I am 5 minutes late to a call. So, Eddie, you are the best. Thank you so much for coming on. All that stuff about CPA, absolutely true. It's on our agenda to bring CPA on. So keep an eye out for all of that. And if you're watching this on the replay, I don't care if it's 3 months from now, comment that you want the chart and Lizzie on our team will send it over. So we want you to be able to connect with Eddie and our team anytime. Cool.
Awesome, guys. Thank you so much.
There are a few other questions, but Lars, why don't you reach out to Eddie? We'll send the contact info. And if there's something really relevant, we can post it in the group. Cool.
Awesome. Have a good day.
Thank you guys. Bye.